know what you're thinking because I thought it too. But escrow is not necessarily required every time you buy a home. Let's talk about it.
What you talking about, Miss Lisa?
What is escrow? Well, escrow is like a safety deposit box where all your funds sit until your real estate transaction ticks all the boxes for down payment, taxes, homeowners insurance. That's where they are in this nice little account we call escrow.
Okay, I could get with that, Miss Lisa. I see where you're going so far. Keep going.
The plus side, using escrow protects your investment. But here's the juicy part. Skipping escrow can mean you have more control over your finances. With an escrow waiver, you can kind of skip the middleman, possibly lowering payments and sometimes better loan terms. But here's the catch. Instead of your lender handling your taxes, insurance payments, you handle them. If you miss an insurance or a tax payment, you are in hot water, my friend. And some strategies are to have the money sitting in an account and you gain the interest on the money, not the bank. Also, I've heard of people using their credit cards to pay their homeowners insurance and their taxes just so they can get the cash back or even the points for travel.
I was with you, Miss Lisa, until we got to the points back on the credit cards. Everything else sounds lovely. To those of you that are watching the video that might like what Miss Lisa is saying, I want to give you a big caution because it sounds good until you have to come up with thousands of dollars. If you're someone that's trying to play the credit card point game and you do not have the foundation, you don't have the behavior of saving and doing all those things beforehand, I would caution you greatly. For those of you guys that don't know me, my name is Robert. And on this channel, my goal is to simplify the home loan process. And I am a lender, 20 plus years helping folks realize their dream of home ownership by getting on the property ladder. And to that end, that's why I come on with these types of videos, not to make the folks that are putting themselves out there and giving information. That's not the goal. It's never personal, but wanting to make sure that we all have the proper information and then just giving a different point of view, because that's the spice of life, right? We all don't think the same way. We're not robots. This is an AI. I'm a real person. So I agree with a majority of what Miss Lisa is saying with a caution, because today a lot of folks are trying to lower the cost of housing, in particular the mortgage payment. And there's a lot of information out here. And you want to hear a different opinion so you don't get yourself in trouble. Because at the end of the day, the taxes and the insurance must be paid. And as you'll see, it's not as easy to remove an escrow account. And you may not want to if you don't have the ability to save. So let's get back into the video.
Hey guys, so I have a great tip on how you can save some money every single month on your monthly mortgage. So if you bought a house with a conventional mortgage and you put less than 20% down, you're probably paying PMI. You can call and get the PMI removed, all right? So call your mortgage company and ask to get the PMI removed. If you bought your house prior to the pandemic, there's a great chance that you have enough equity in that house that you can get the PMI removed. All you need is more than 20% equity, and you can get the PMI removed by either calling and requesting that they remove it, or two, by refinancing the loan.
So Alicia, what's happening, Alicia? Good job. What she's saying is true in that if you have a large enough equity position from the time you purchase the home, less the principal pay down and potential appreciation, if you have that equity position that you would need, your lender, your servicer could potentially remove the PMI earlier than it's scheduled to be removed. A couple of things you must know about that. If you have an FHA, a VA, or a USDA loan, this is not applicable to you. And she said it in the beginning of her video, you have to have a conventional loan. So that's number one. And the rule is this: from the beginning loan amount, you have to have a 22% equity cushion that can be derived by principal pay down and appreciation. And once you have that 22% cushion, then you can request the PMI to be removed on a conventional loan if you have it, if you finance more than 80%, right? and your servicer should do that for you. Now, you have to make the request if it's prior to the time that it's mandated to fall off. Okay? So she's correct there. Just to recap, if you have an FHA, VA, or USDA, you cannot remove PMI. FHA, it's equivalent to the mortgage insurance premium. And there is an FHA loan. If you put 10% or more down on an FHA loan, it's similar to conventional loans in that once you've paid down that 22% position or have achieved the 22% equity position, you can have that PMI removed. The difference on FHA is it's going to be about 11 years. You can't expedite it. And so if you have a regular FHA loan or you put less than 10% down, the mortgage insurance premium is going to be for the life of the loan. If you are a VA home buyer, you don't have private mortgage insurance or mortgage insurance premium. And if you don't qualify for the exemption of the funding fee, the upfront funding fee, then you have to pay that. Either bring it forth in cash or you can finance that in. USDA doesn't have PMI, but they have an annual fee that's going to be for the life of the loan. So conventional loans are what this is applicable to. You got to have that 22% equity position. And if you achieve that before roughly the 11 years, sometimes it's between 11 and 12 years that you will naturally hit what? That 22% equity position from the original loan amount, then it would fall off automatically. Just wanted to make that clarification. Let's go a little further and see if I have to agree or add on to what she's saying.
The thing is, most people will pay the PMI through the life of the loan because they don't know that you have to call and get it removed, all right? I just saved myself $100 every single month on my mortgage by calling my mortgage company and asking for them to remove the PMI.
So one little clarification there. The Homeowners Protection Act, 1998, mandates, it's a federal law, that mandates that once you've reached that halfway point with your conventional home loan and you're not delinquent, you cannot have been late, the following month from that time frame, the servicer, the place where you're making your payments, or your lender, all lenders aren't servicers, if those things are applicable according to that law, then your private mortgage insurance will fall off your home loan. As she stated earlier, if you get there sooner because of your principal pay down and or appreciation, get you to that 22% equity position before the halfway point, then you can request for it to come off sooner. Even in those examples, you have to be current. I've seen instances where you're late and it doesn't work because Dodd-Frank, it's another rule that was amended after '08 kind of filtered out to 2013, where it amended the truth in lending to where certain lenders and servicers have to have certain reserve requirements, and they have to make sure that all of us that have mortgage loans have the ability to protect the asset, the underlying asset, with the taxes and insurance. Because prior to that, the things that led up to the housing market crisis from '08 to 2013, when we came out of it for real, was those lenders, those servicers only had to have a 1-year requirement. Now they have to have a 5-year requirement of escrow accounts. And that protects the end investor, because the end investor has to get their money back, or we here in these United States don't have access to the 30-year fixed interest rate mortgage. If you don't believe me, look north of us in Canada. They got 30-year adjustable rate mortgages that readjust every 5 to 7 years. Nowhere else has these types of loans. If they do, let me know. This is why the escrow accounts are in place, and why all of the government insured accounts, it's mandatory. You got to have it unless you have that FHA scenario, or if you're getting a VA, right? It comes in different forms. It's insurance to make sure that the end investor, the ones that are buying these bonds, they have to get paid back. They got to get their return back, or you are going to have to come up with 100% of a purchase price of a home. So this gives you some context to why it happens. And for me, hopefully, same thing for you. it helps you understand why things are the way they are. And you don't have to be a victim. You can understand the process in which way it works, because to be able to leverage a little as 3% up to 20% for hundreds of thousands of dollars is a great thing if you understand it, if you're mature, and you're able to take advantage of the opportunity. I'm through preaching. Let's move forward.
Homeowner hack: if you want to lower your payment monthly, you can remove your taxes from being charged on your impound account. So right now, if you just bought a home, your taxes are bundled with your mortgage. If you want that separately in a separate bill, you can ask for that to be removed from your impound account, and they won't deduct, or they won't add on that fee for your taxes into your mortgage, and you get a lower payment, and then you'll get a separate tax bill for your home taxes. So yeah, this is a great way if you just want to take more control of that and you don't want it built into your mortgage. This is a great way to do so.
So shout out to you, Jocelyn, for, again, putting yourself out there and doing content, because it's not easy, and it's going to pay off in spades. Just stay at it. With that said, wanted to show her video because a lot of the information out here is very vague, and it implies that you just have to pick up the phone and say, hey, I don't want an escrow account. Well, as we've gone over in the first two videos, not as easy as you think, but specifically, how can you not have an escrow account? And we'll just run it down by loan type, okay? So first and foremost, for conventional loans, you must put down 20%. That's the minimum threshold, or your loan to value cannot exceed 80%. So easy math, $100,000. If you put $20,000 down, that's 20%. Your loan amount would be $80,000. Now, sounds good, but this is something else that people don't tell you. If you qualify, right, which you would in that scenario, and you're not going to allow the servicer or the lender, the place where you're making your payment, collect the taxes and insurance, your interest rates are typically going to be 0.25% higher. There's going to be a hit to your rate. Nobody talks about that. Now, there's ways to potentially not have to pay that, but again, we're educating. This isn't just about you hearing what you want to hear. So again, the reason I brought the young lady on, a lot of times I can tell she's probably newer in the profession, and again, don't want to kill her spirit. But if you're newer in the profession, we got AI, we got a lot of stuff. Tap into a lender, build a team, and reach out to those folks to make sure we're giving good information. So we aren't just attracting people, because if we do not protect who's getting into a home, then the benefit of leverage is going to be taken away. And then this is when a lot of you guys are going to start moaning and complaining, especially those that were never going to buy a home anyway. I'm trying to protect those of you that really are serious and are trying to get onto the property ladder. So you got to partner up. You got to get the right information so that folks don't go out and get into, say, a FHA, VA, or USDA loan thinking they could just pick up the phone and remove the escrow account. You can't do that. So 20% down conventional qualifies you to not have to have an escrow account, but there's going to be a hit to the interest rate. Remember that, okay? Again, FHA, no way to remove the impounds. It's going to be there. It's mandatory, right? You might be able to get rid of the PMI if you put 10% down over an 11-year period. But if you don't, if you leverage, or if you put 3.5%, the minimum, or anywhere in that continuum between 3.5 to 10%, then the mortgage insurance premium, that's equivalent to private mortgage insurance, PMI, same concept, is going to be for however long you have the loan, the life of the loan, okay? VA doesn't have private mortgage insurance. You don't have to worry about that. And if you have a 10% or greater disability, you're not paying the funding fee, either the first time use or subsequent use, based upon your branch of service. It's a whole nother video. And then USDA has an annual fee that's for the life of the loan, however long you have that USDA loan. So hopefully this makes sense. And again, young lady, continue to do what you do, because as we continue, hopefully we get better. But that's how you can qualify on a conventional loan not to have to have an escrow account. And if you decide to do so, and hear me out, hear the old man out, and I'm out of here. I've dealt with people that have literally, I've dealt with millionaires, okay? Not paper millionaires, folks that got $1 million net after cash in the bank, okay? As well as everyday folks like me. I'm not rich like you guys. At the end of the day, you have to make that tax and insurance payment. And those 12 months or whatever interval you're on based upon where you live, it might be 6 months, whatever the taxing authority rules are in your locale where your house is located, it comes quick. So if you're not a person that has had the discipline and has shown that, hey, I put money to the side, man, get an escrow account. The $2-3 that you're going to make in a high yield savings account or treasury note, it's get an escrow account, because too many times have I heard folks, man, I don't have the money, because it's going to disappear. So do what you want to. That's my opinion. If you like videos on other topics, drop in your suggestions in the comment section and we'll do a deep dive for those of you that are subscribed to the channel. That's it. You guys enjoy your day. Be safe, be blessed, and then until the next time, peace.